you can see, this topic is gaining momentum internationally. There are so many interesting initiatives such as the Harmonized Protocol, as Steve just briefly talked about that, led by the Natural Capital Coalition. At the UN and national levels, there are initiatives to build the value of natural capital into national accounts next to some traditional metrics like GDP. A finance-led initiative, the Natural Capital Declaration, which is signed by over 40 CEOs with the objective to build natural capital into business decisions. TrueCost is doing a lot of interesting work on research and helping companies in this space. Also, they developed the Natural Capital Leaders Index, which is quite interesting. So we'll provide you with a few of those initiatives in the appendix of this slide deck. I would also, before I start talking about natural capital and what this means to us, I just wanted to say that it's quite interesting that this is the only topic on which there was a strong agreement at Rio +20. So I think that should mean something, that this is going to be a growing and emerging field. So what exactly is natural capital? There actually isn't a widely acceptable formal definition out there. But as you go through this session, you will see that many aspects related to natural capital are not all that new to you. And the positive aspect about using this phrase is that this dialogue is really uniting ecologists, economists, and business people on the importance and potential solutions. So we need to continue this dialogue. And when we refer to natural capital, we are speaking about natural assets such as the stocks, so fish stocks, land resources, ecosystems, and services. So what are ecosystem services? I'll just briefly go over these so we have a good understanding and the background to this knowledge. There are four main types of ecosystem services. This is how they were categorized in the Millennium Global Assessment Study. Provisioning, so the products obtained from nature and often sold, such as biochemical products for medicines, crops and timber. Regulatory services, such as nature's regulating processes, flood control, erosion control, and pollination. Supporting services such as nutrient cycling, and of course, cultural, which are subjective benefits and recreation. So all of these provide a lot of benefits to societies and businesses to function. So now we'll look at what natural capital valuation is really all about. And once again, there is no broad formal definition of natural capital valuation. However, valuation or accounting of natural capital is really an attempt to assign values to the services provided by nature, and more frequently to put a price on the true impact that a business has on the natural system. There's a common consensus that valuing nature is one of the potential solutions to help maintain the integrity of our natural system. If we really understand the true value and cost of the impact, we will be in a better position to make better business decisions. In fact, this was a major topic of discussion at the World Forum on Natural Capital last November in Edinburgh, and valuation is actually a big topic of conversation when it comes to natural capital integration into business. And because valuation is meant to calculate the true cost of impacts or externalities, it's important to understand some of this economic jargon. So we'll quickly go over some of that. So when we're talking about externalities, we're usually talking about negative externalities, like impacts of business, so pollution, effluent, emissions. However, externalities can be positive as well. So for example, if a company restores land, this is a positive externality. And we are definitely gaining more knowledge on the costs of externalities and generally impacts of business on society and the environment. I believe the first major study we saw was the Stern report. There are also estimates that pollution in China is costing us about 10% or costing China about 10% of the GDP. There are some interesting estimates conducted by TrueCost, so the company that does research, and helped Puma with their environmental profit loss account, that major industries are costing us $7 trillion a year in environmental impacts, which is equivalent to 13% of the global economic output, which is huge. And there are commodities. So trading schemes and eco-fees are some ways that we're trying to incorporate those costs into the business. So why is integration of natural capital and valuation so important? So of course, with population growth dynamics, pressure on planetary boundaries, and land use competition, resource constraints, like these are already really changing the game for business. There are lots of challenges that business is dealing with. There are various studies and global metrics suggesting that we're on a pretty dangerous trajectory, and I'll touch on some of these briefly. So there's a study commissioned by Kofi Annan, the Millennium Ecosystem Assessment, which revealed that 60% of our ecosystem services are actually degraded. We recently saw the Geo5 for Business report, which distills the global economic or environmental outlook for business and discusses implications, so the risks and opportunities, some major trends identified which are going to continue posing challenges to business, such as greenhouse gas increases, which will probably cause more floods and droughts, continued pressure on water availability and quality, where demand exceeds the supply. We're also at risk of continued loss of biodiversity, and there are hundreds of chemicals in use that we don't really understand very well. Another interesting scientific research was conducted by the Stockholm Resilience Center. So here, scientists identified and quantified a set of 9 planetary boundaries and societal must-haves. And this research identified that 3 of these boundaries, so those for climate change, nitrogen cycle, and biodiversity loss, have already been surpassed, and we're in the danger zone for several others. So understanding all of these impacts will definitely help business prepare for some of these changes and know what to anticipate. And it's also important to recognize that natural capital is so closely linked to social capital. It's not just about the environment, but it's about poverty and eradicating poverty. So this is particularly important in developing countries where about 1/3 of the national wealth derives from natural capital. And of course, poor management of nature and resources will just make poverty worse in those regions and compromise the integrity of the Millennium Development Goals. So what does this mean to business? Let's look at some of the risks. Of course, there are some risks that are common to all sectors, and some sector-specific risks. So these are just some very high-level examples of risks in different sectors. Water is a huge one for all sectors, and according to the World Economic Forum, it's actually listed as one of the most significant business risks. According to TrueCost, if prices were more aligned with actual availability, around 27% of profits of some of the largest companies could be at risk. Of course, there are other risks like commodity costs, regulatory risks. So here we're talking about limits on resources or permits and licenses, disruption to operations due to weather patterns, reputational risks, such as when companies are sourcing from an unsustainable supplier. We've seen many examples in the past of that happening. And let's have a closer look at the food and beverage industry, which actually is, according to many studies we have seen in the past, is one of the most significant industries in terms of environmental impact. Agriculture requires a lot of water, energy to run equipment, and for feedstocks to produce fertilizers and pesticides. So food and beverage companies are exposed to a lot of resource and inputs, pricing risks, climate change, drought, which cause yield losses, and these are already starting to affect profit margins of companies. Retailers, for example, we've seen in the past few years that some retailers took quite a big hit because of cotton price increases, and cotton has over the past years increased up to 90% in some regions. So companies, even like H&M and Gap, were definitely affected by this. If we look at the pharmaceutical industry, which is very, very dependent on biodiversity, and actually it's estimated that up to half of the value of the product or market is attributed to genetic resources in nature. And this industry is very vulnerable. And actually a study conducted by KPMG and the Natural Value Initiative estimated that extinction of biodiversity is causing one major drug to be lost every 2 years. That is a huge implication to new product development and opportunities for the pharmaceutical industry. Resource-intensive industries, extractives, for example, are definitely not exempt and very vulnerable here. They'll continue dealing with land disputes, challenging stakeholder relationships over resource management, and because how resource-intensive the extractive business is, this sector is highly exposed to pricing risks related to water, energy, and of course also financing risks. For example, the IFC performance standards are applied by some lenders, and these outline strict criteria related to biodiversity management. So if a company fails to manage these issues adequately, they may have issues with or challenges accessing funding. So these are the International Finance Corporation. Sorry for the acronym used. And also we're seeing some divestment trends away from heavy greenhouse gas emitting industries, and it'll be interesting to see how this continues. For example, the Norwegian pension fund, which is one of the largest in the world, is divesting away from heavy industry. So we'll probably continue seeing more of such trends. And now we'll have a look at some high-level opportunities and benefits to business. So really, by understanding the impacts and dependencies on the natural system, we have better insight into the value chain and geographical context of operations, and of course the ability to identify risks and trends that can be problematic. So this gives us the opportunity to take the right steps to manage them. There are different ways that companies are responding to natural capital risks. Some are changing sourcing strategies and improving their products. For example, Patagonia is substituting with organic cotton, so they're sourcing from organic cotton suppliers to reduce their impact, and they have very strict merino wool sourcing practices. I believe most of us are familiar with Unilever's sustainable sourcing practices. They're quite ambitious, particularly around agricultural goods. And valuing natural capital, even for internal purposes, really enables companies to link sustainability to value creation and monetary assessment of risks. And this is not often practiced at companies. We often don't know what the true value or what the true risks are in monetary terms. So at least we can make an educated guess here. And actually, a recent KPMG study of global reporting practices identified that there are very few companies that are doing this. So they see this as a huge opportunity. And internal shadow pricing is actually on the rise. CDP identified that there are at least 30 of their reporters that are applying shadow prices to resources like water and some impacts like carbon to try to understand long-term risks and what could that mean in monetary terms. Mountain Equipment Co-op uses progressive shadow pricing to understand true cost of decisions and to prioritize various initiatives. So companies are taking advantage of some of these approaches available. And of course, reporting on natural capital provides the opportunity to be more transparent with disclosures and to provide a more comprehensive account of our impact on the environment. Many businesses are taking advantage of natural capital valuation for informing certain strategic decisions. Like for example, Dow is working with the Nature Conservancy to better understand and assess values of ecosystem services and business decisions that they're incorporating into expansion plans or developing plans. Sam Miller is doing similar work in Bogota. Relationship building is a very important benefit and opportunity around natural capital, because organizations and businesses oftentimes share similar interests with respect to resource. For example, H&M is working with WWF on a water strategy to improve water management in regions of scarcity, such as Bangladesh and China, where there's a lot of production, textile production. Other companies are striving for net benefits to society, such as Coca-Cola, through their Replenish initiative, where by 2020 they plan to return the volumes of water equal to what they use in their products back to the environment. Others are exploring with the closed-loop model, demonstrating California, working with or engaging with broader stakeholders and thought leadership to try to define what is a responsible economy and one that doesn't negatively impact society and the environment. So that's quite a bold initiative. So there's lots of interesting opportunities that companies take advantage of. So now we have a little bit of a better understanding of what natural capital and valuation is and some of the major global environmental and economic trends, as well as an overview of some general risks and opportunities. But how do we apply natural capital thinking and considerations in business? So here I actually reviewed quite a bit of research and tools and case studies. So this is my attempt to try to distill and identify some approachable ways that companies can employ to assess their impact on natural capital, from simplest to the most challenging. And I'm sure that this is not all, and there's many of you on the phone will probably have lots of other ideas. But these are some that I think are quite viable to employ. So we will look at some of these through a combination of tools and case studies, starting with the first. So the first is really focusing on a non-valuation approach, so essentially on understanding impacts and dependencies on the natural system, regional trends, risks, and identification of opportunities. This is definitely a great place to start, whether a company eventually plans to do valuation or not, because it gives you that general understanding of your value chain and risks related to certain commodities or resources. So it's really important to map out that value chain, obtain that traceability so you can identify natural capital risks and opportunities. So where you're sourcing from and what are the risks to the key products in your business. What are some of the trends in the various regions of operations, and what can that mean to your bottom line in the future? We will get a brief overview of how this can work in practice using a publicly available tool which was developed by the World Business Council for Sustainable Development and the World Resource Institute. The second approach focuses on identifying efficiency ratios. So how does your business compare on resource use against competitors and peers in similar geographies? So for example, what is your water use per unit of revenue or energy consumption per unit of revenue versus your competitors? So let's say your competitor can generate $1 million using less water and energy than you. You can perhaps do a benchmarking exercise to see what they are doing that you are not. There could be some opportunities for efficiency improvement. And when doing this, make sure you reinforce your analysis with using other metrics such as resource use per employee or square footage to supplement some of this thinking and to understand the limitations, because of course, the revenue ratio won't give you everything. But this is a good way to gauge your general position of where you're at and with respect to resource use. True Cost is actually doing some interesting research in this area, and they developed a natural capital index that you can look at to see how companies are performing with respect to resource use. That's available in the new Green Biz report. The third approach is a cost-based valuation. So you can use this if you have an account of your impact. So if you have a footprint analysis or other key metrics that you've gathered in your business, you can actually apply the market values and then calculate the cost related to those impacts. You can try to understand the potential of cost avoidance and actual cost avoidance of related to various initiatives. And we will look at this a little bit more closely when we get to the Canadian Tire case, a very mini case study of Canadian Tire. And this approach is actually not too onerous, and it really allows you to understand where the greatest costs and opportunities lie using one unit, of course, the dollar value, and it's focusing on the current situation. So it also helps with the internal business case, and it helps you link your work to corporate finance. And the fourth approach is about shadow pricing. So looking at what are some acceptable values that you can apply to your key impacts, such as carbon or water, to understand risks in monetary terms, particularly for those goods or inputs where increases in price or legislation changes are quite likely to happen in the future. So water is definitely a huge one. And if you have, for example, just to give you a quick example, in operations in a water-scarce region, you may want to develop different scenarios to try to see what those costs could be 5 or 10 years from now, what are the trends in that region, and what will be the impact of those potential price increases to your bottom line. You can also research to see what your peers are doing or other companies in similar regions and what kind of shadow pricing is applied, so you can potentially use the range that's out there or a mean. And this really helps companies quantify longer-term risks and understand the potential dollar value and prioritize various initiatives. And once you do that, chances are that you will get the attention of the risk team in your company to help you focus on some of those key issues that are challenging business. And the last and most rigorous and intensive approach is that full supply chain valuation of key impacts. And we will look at this a little bit more closely in reviewing Puma's case study. And understanding the full cost of the supply chain really helps companies to prepare for pricing risks and identify opportunities at an operational and product level, identify sourcing strategies that could help companies reduce costs and risks. And this is also a great way to be transparent with stakeholders on your impact and how they link to the business. So we will look at some methodologies so we can understand this a little bit in a little bit more detail. I apologize for more economics 101, but this was supposed to be a natural capital 101. So we're going to just quickly go through some of the methodologies that are often employed so that when we're referring to these case studies, you have a bit of an idea as to where these numbers come from. So I should say that these methodologies are not applied consistently. Companies set various scopes, they collect data differently, and there are lots of limitations to actually getting that reliable data that's fit for the valuation that companies want to take in their business. So there's really a great opportunity to refine and standardize the methodology. So we should all be happy that the Natural Capital Coalition is working on this. So the methodologies there are really two main types of categories, the market and non-market valuation. So the market one values activity for which prices are not available or market prices are not available. And the non-market applies to situations where market prices are not available. So the first one, yes, did I say where prices are available? Okay. Just want to make sure I get this straight. And so the cost base is an example of the market-based methodology. So it enables the evaluation of potential costs incurred or avoided or replacement costs. So for example, estimating damage caused by floods, which might be related to the destruction of mangroves or costs avoided because of various investments. So for each, I'm just providing a couple of examples. And we will see how this works and can even hire a case study. And the bigger challenge when it comes to these methodologies is the non-market valuation, as we will see in the case of Puma, so assigning values to issues or impacts that are not, where we don't have the actual cost or market cost. But these are quite helpful in understanding trade-offs and consequences of decisions, and even if they're not perfect, they still provide a lot of insight into the business. So when we're talking about non-market evaluation, one of these is reveal preference. So for example, the actual spending that demonstrates how something is valued. If you're purchasing a waterfront home, that gives insight into how much you value the local ecosystem versus somebody purchasing a home that's not facing the water. So that difference can give you insight into how much the ecosystem is valued. And then there's the state of preference. So this is based on surveys asking for willingness to pay or willingness to accept. And this is a tricky one because, of course, there's usually a disconnect between revealed preference and stated preference. And then there's the value transfer approach, which is the easiest because you're just simply taking values from another situation or case and applying them to yours. But you just have to be aware of the limitations and also be very transparent around how you use these methodologies. So I hope that didn't confuse people, but I thought since we're talking about the case studies, it'd be nice to get numbers come from, you have a bit more idea. Okay, so now we'll just go over this World Business Council for Sustainable Development and World Resource Institute tool. So this is a very helpful guide, and it's publicly available for you to take advantage of to assess impacts and dependencies on the natural system. It has been used by hundreds of companies. There are lots of examples and case studies that can help you go through it. So it's a guide with a step-by-step process, with tools and materials, and you can download that as you visit the World Business Council website or World Resource Institute. So I'll just go through this very quickly, this tool. And I should also say that this is a non-valuation approach. So here you just, when you're trying to understand those impacts and those dependencies, from a qualitative perspective, this is quite helpful. So this tool is made up of five main steps. So the first one is defining the scope. So of course you want to decide which part of the value chain or operations you want to look at. So whether you want to focus on your product or a project or a certain geography, and of course you want to focus on an objective that supports your business goal and your strategy. Step 2 involves identifying and prioritizing the main ecosystem services. And there's a tool that we'll see in the next slide that helps you do that. Once you've defined the ecosystem services, the key ones, you can do a trend analysis to try to understand what are some of the main drivers and trends and risks to your key ecosystem services that you depend on. And then you'll want to do a risk and opportunity analysis, preferably with external stakeholders and a cross-functional team in your business to try to understand different perspectives, and then plan on how you're going to approach some of the challenges in your business. So on the next slide here, so we can see what this tool looks like. So this is just an Excel spreadsheet that you can use to identify your key impacts and dependencies on the natural system. So there are guiding questions that you could go through, and you'll answer the questions, and at the end you'll get a summary of what your key impacts and dependencies are. So questions are, for example, does a particular service enable your business, or does your company affect that quality and quantity of that particular ecosystem service? So these are straightforward questions that you can answer, and then you'll get a summary that shows you what are the key impacts. So that's just a really helpful tool that you can use in your business.
Hey, Yash, I just want to comment that we can make all these tools and downloads available to all the participants online today after the call. So, capture what you can in the essence of the call, but you can dive into these more deeply afterwards, and we'll make sure we distribute them to all the participants. Thanks.
Yes.
Please continue.
Yes, and actually at the end we also show links and some of these various tools, because there's quite a lot that you can take advantage of. Okay, so now, we've seen that a non-valuation approach of how to use a tool to identify some impacts on the natural system. So now we'll very quickly look at how Canadian Tire applies the cost-based valuation approach in their business. So Canadian Tire uses the market cost approach to understand avoided costs related to their sustainability initiatives. The company's strategy focuses on improvements and efficiency in the areas of energy and climate, so focusing on reducing carbon footprint, eliminating waste and packaging, on optimizing the supply chain and logistics, so that they're reducing that aspect of the business or impact on that aspect. And Canadian Tire actually reports forecasted avoided waste, energy, and emissions, and the subsequent savings to the business resulting from those sustainability initiatives. So this is an example of measuring costs in an interesting way, because you're calculating sustainability benefits and applying that to business. So doing this helps to drive the internal business case for sustainability, and there's a clear link The actual values reported are based on a 12-month forecast occurring after each of the projects. So they list all the projects, they list all of the different initiatives that they take, the costs avoided financially, and impacts to the environment. And I should also say that so this in Canadian Tire, the sustainability team and the corporate finance team work close together on this. So putting together these disclosures, understanding them, interpreting them, and then planning some next steps and initiatives in the business. Okay, so now we're going to have a quick look to see how Puma does their evaluation of the full supply chain. And this is definitely the most challenging of all the different approaches. And I'm just providing some high-level information here so we can get a bit of an idea. So Puma developed an environmental profit loss account to find out how much they would have to pay for nature services if they had to pay for it. So, and this is actually the first company that developed a full supply chain environmental profit and loss account. So they wanted to identify risks such as issues related to resources and scarcity and inputs, because in their industry they're quite exposed to increases of costs related to various resources. And the environmental profit loss account, or EP&L, shows the monetary values estimated by Puma for their environmental impacts. So the cost of Puma's footprint on the environment across all of the operations and the supply chain. So as we can see on this slide, most of the costs are actually in the last supply chain tier, linked to greenhouse gases and water and land use, largely attributed to agriculture, cotton and cattle grazing for leather. So those are obviously big challenges to manage, since the operations are so far from that supply chain tier. And assessing the impacts to one unit, the cost, allows for risk analysis and identification of priorities in the business. So now, how do they do this? So actually, TrueCost and PwC developed a methodology for Puma based on non-market values. Data was collected from various operations and suppliers where available. Puma had to identify a lot of different business processes like management systems and records of various purchases. And the rest of the data was obtained through input and output modeling, a system that analyzes economic flows and resource inputs and outputs. And you can learn more about that if you visit the TrueCost website and read about, and visit Puma's website to read about that case study. And then the environmental impacts were calculated using country-specific impacts, translated into financial values. So the price given to the impacts really reflects the environmental cost or cost to society resulting from various business activities. So the actual values are derived from academic journals and economics literature using methodologies similar to some of the ones we discussed in the previous slide. So as an example, for greenhouse gases, Puma used an academic journal that's widely accepted to derive these valuations. There was a range of various values, and they picked a middle point that made sense to their business. For water, this was values based primarily on scarcity through modeling of a relationship between value and scarcity. So of course, as the value increases, that's because the water scarcity increases as well. So in the next slide here, we can see how does Puma apply all of this. So this is just an exercise that serves as a strategic tool to help identify some new impacts and product opportunities, efficiency opportunities. So Puma applies this knowledge to develop a new product in this particular case. So they realize that impacts associated with their conventional T-shirt are significantly higher than impacts generated by a biodegradable organic T-shirt. The impacts are lower by 30%, so diversification. Puma continues to work with their suppliers on efficiency improvements, capacity building, various sourcing strategies, and actually carrying the parent company is rolling out this environmental profit and loss approach to the entire group, and that should be published, I believe, in 2016. So that will be quite interesting to see how that gets rolled out. Okay, so of course, time goes by quickly in these webinars. We don't have that much time to cover everything in detail, but I hope that everybody learned a little bit through these case studies and potential approaches. And as we can see, this is such an exciting area with so many new initiatives and developments underway. We're all at the very early stages, but there's definitely so many more opportunities to work in this space and to refine these methodologies, strengthen the business case for doing this work, generating more case studies that can help us, working on those methodologies. So I look forward to see how all of this unfolds, and I'll just leave you with a bit of a summary of some of the key learnings, and this hopefully will help. So here are just a few points to keep in mind when you're assessing your impacts on natural capital. So refine your objective, ensure there's a link to your business goals and key business issues, whether it's a cost of commodity or scarcity issue or resource pressures. Understand your value chain. So what is the key issue, the key input or entry point? Start with maybe one or two impacts or issues, and then expand the scope as time progresses. And once you understand your full value chain, the landscape around the key resources and commodities, you have a general idea of the risks and opportunities. Identify the right approach to assess your impacts. So whether you want to understand the general ecosystem, services, risks and opportunities, you can use a guide such as the World Business Council guide to be looked at to see how your natural capital impacts compare against those of peers. Look at water and carbon footprints of competitors to understand potential exposure to rising prices. Look at some shadow pricing exercises, and to value broader costs of business impacts on natural capital. Gather some of your metrics and key impacts and identify common and used acceptable values. To start, you can also look at some the values applied by peers and competitors, and that's before you want to embark on a very complex and robust exercise such as Puma's. And once you have done that assessment, identify the most costly and intensive impacts, some of the most promising opportunities, and ways to address them. And also just remember to be transparent about what you're doing and communicate this to stakeholders.
Oh, sure. Yeah. So thanks very much, Agnieszka. What we'd like to do now is move into a bit of an implementation discussion, correct? So we've got Caitlin Olmack, who's a consultant with a focus on multi-stakeholder collaboration, and has previously worked with the Economics of Ecosystem Biodiversity Project, and she's currently working with ICA Associates, a social enterprise focused on designing and facilitating participatory processes. So as you can imagine, with something this complex, in order to implement and engage an organization effectively, it requires a sound strategy. So Caitlin's going to take us through some suggestions and guide us down this path here. Caitlin.
Great, Steve. Thanks so much. So I'm going to just spend a few slides going over natural capital management and what that would mean for your business. So natural capital management is the behavioral and organizational change which happens when you take natural capital accounting and implement it. And the overall goal of natural capital accounting is the sustainable management of ecosystem services and value chain impacts. So this is looking at how we would implement valuation once it takes place. So natural capital management is considered a business innovation that drives a change in decision making. So this could be changes to business practices, strategy, and the system. Natural capital valuation is the centerpiece of natural capital management. So without the valuation and the information piece, it's very hard to integrate this into strategy. And with natural capital management, we see leadership is very important. The companies that have been successful in integrating natural capital into their business practices have been led by a top-down business effort by senior leadership driving it into business. So we're just going to take a moment and look at some of the common barriers organizations face when implementing natural capital initiatives. And this was taken from a T for Business Coalition report, and these are trends from 26 different businesses across 9 different industrial sectors. So these are 4 common barriers. The first barrier is relevancy. So the question of why is natural capital management relevant to us? So companies may understand that it's relevant because it benefits humanity, it benefits business in general, but the business value and the business case might not be apparent at first. And the second barrier is measurement. So as Aneshka explained, it's very complicated sometimes to know how I should measure ecosystem services and how I should measure them. So this gets at the question of what data and methods should be used and how. And that's the lack of data is a challenge currently for companies trying to implement these efforts. The priority barrier has to do with prioritizing natural capital initiatives over other activities within the business. So this might occur when natural capital management might not be too exciting and the plan might not be available to implement. So this has to do with when should I implement natural capital management? When is the best time? And another challenge and organizational barrier that is found is the integration barrier. So how to sustain natural capital management in my business? So this has to do with integrating natural capital management projects into existing strategies and systems. And within all this, these are the organizational barriers, but one of the other challenges is the system-level barriers. And these include lack of consumer demand, lack of industry standards for natural capital, lack of pressure from investors, and also lack of government regulation on what natural capital measure and how. So this all may seem very daunting. So this is just a slide to explain how you might get started in measuring and valuing natural capital in your business. So the first step is kind of creating a shared vision. So where do we want to be in managing natural capital? How do we want to do this, and where do we want to be? And looking at the obstacles that you're facing in your business to integrating natural capital. So these could come, again, as relevance barriers, measurement barriers, priority barriers, or integration barriers, but really, what are you facing? And then looking at those barriers, what can we do to remove some of these obstacles? So this might have to do with recognizing natural capital within your company. It could have to do with getting trained in natural capital. Another strategy could have to do with evaluation, so getting a better understanding of what natural capital means to your business. And adoption, so starting small, taking a small project and programs related to natural capital, and also enabling a long-term view within your company. So taking some of these big obstacles and breaking them down into strategies, and then coming up with individual actions to get the practical plan on how to implement natural capital. So an individual action could be maybe taking a course in valuation, or engaging your employees in some more educational efforts on what this could mean to business. So taking some of these first steps into account, what's next for natural capital management? So pioneering companies are expected to build natural capital into their core business practices in the next 3 years. So this is quite an urgent and quick topic. The risk is greatest for companies involved with freshwater, renewable energy, climate regulation, fiber, and food in the next 3 years. So as Aneshka explained, delaying that natural capital management carries a great risk. So it's important that we just get started in looking at the small steps and things we can do to remove some of the barriers we currently face in natural capital management. And there's a need for more case studies about how companies have taken valuation and taken really great reporting and actually integrated it into change within their company. So, thank you.
Great. Thank you, Caitlin.
Just bring attention to these. So I just wanted to quickly bring everybody's attention to one of the tools that's actually quite helpful. So that's so the examples of tools, and those are just a very few of very many tools. But I wanted to mention mention that the first one here, which is the Eco for Biz, is a compilation or overview of so many different tools and methodologies. There's a decision tree, so you can actually start there. You can use that to identify what your business needs are. So I just wanted to make sure everybody sees that, because that's an interesting one. And there's a question around the difference between the shadow pricing and the full-blown Puma example. So it's really about scope, because shadow pricing, you can apply that to one or two key impacts within a limited scope. But the Puma example, I mean, they do that, but in a very, very broad and complex scope, looking at so many of their business processes and operations, and their methodologies are also quite robust. So there are similarities, but the shadow price, or taking one, if you take a couple of impacts and do that, it's much easier than pursuing the full environmental profit loss account. But that's, you can all strive to that.
Yeah, just remove some of the barriers, and then once you get started, it'll be a lot easier.
So thank you very much for getting this very important discussion started and kind of peeling off some of the layers of an incredibly complex approach, but I think a very sound approach when we're looking at true business evaluation. I just want to ask all of our webinar participants online, there is a chat box in the bottom right-hand corner of the open window, your browser. If you have any questions for either Agnieszka or Caitlin about natural capital or the implementation of natural capital management system, now would be a good time. Don't be shy. And I have a couple of questions just to kind of get the party started while people are typing. And one of which is the majority of the participants on the phone, although I was quite pleased when I saw the registration list this morning, the complete registration list. We've got folks from virtually all industry. We've got NGOs. We have folks from conservation authorities. There's a really nice, robust group of people that are interested in the subject. So I think that that says a lot about who it's resonating with and who's perhaps looking for other methods of evaluation and measurement. And so one of my questions is, we do have a number of people on the phone that are coming from CSR backgrounds and corporate sustainability backgrounds. And as we were going through the challenges of implementation and the different approaches to evaluation, it seemed to be there were similar barriers and challenges that a traditional CSR department has in rolling out their program in great many ways. So I'm wondering if it's kind of a two-pronged question, one for you, Agnieszka, and one for you, Caitlin. One which is, Agnieszka, for an organization, given that we have some small orgs and some larger orgs on the phone, and there are different levels at which you can enter, given that the average company is probably not going to take the Puma approach and take the environmental profit loss like right out of the gate. That would be fairly ambitious. Do you have a recommendation as an entry point? I know you said start small and sort of pick a few key core metrics to measure and kind of build it out from there. But do you have sort of a baby step into natural capital evaluation that you can recommend? And then the second part of my question is for Caitlin, which is a similar question, which is from an organizational management perspective, how do you implement these things? I mean, this is, again, CSR is quite often a challenge. Getting HR involved, for example, in CSR initiatives has been something that I think we're lacking a little bit in most organizations. So I'm wondering if from both in a methodology approach, Agnieszka, if you could comment, and Caitlin, if you could comment a little bit about baby steps into the concepts of natural capital management. What's a great entry point?
Right. So thanks for that question. I guess which slide? On slide 8, if we can go back to the slide with the approach. So those are some potential ways that companies can move forward with this. And I think, sorry, maybe the next one. Sorry. So the important thing is to really understand your objectives. Is it to understand risks related to certain commodities or certain resource costs? And because if that's the case, then you can apply some shadow pricing. If you want to look at what are the potential costs or cost avoidance related to sustainability initiatives, then you might want to apply the cost-based valuation that Canadian Tire uses, right? So, for example, if you need to build your business case, then that's a great way to start. They say, well, look, there's a lot of opportunity here for us to save costs and be more efficient. you just want to get a general understanding of where you're at and what are some of the main risks and opportunities related to natural capital, really try to understand your value chain, get that traceability out there, and try that tool, the World Business Council tool. It's quite user-friendly, and it'll take you through the process. So even if you want to do valuation eventually, that's a great place to start to get the general sense, and then you can take it from there. So yeah, value chain, and then really just understanding that.
Eco for Biz is a great kind of self-assessment tool you're suggesting as a starting point. The World Business Council.
So that one, yeah, that's called Ecosystem Services Review, and then the Eco for Biz is a compilation with everything. So yeah, you can actually do a little decision tree and then identify the tool that's right for your objectives.
Again, so we'll share all of those resources. I know they're embedded in the presentation, but we'll make sure that they're available after. Caitlin, do you have a comment on that?
Yeah, in terms of baby steps to begin to implement natural capital management. Well, the first step is really creating recognition that management of natural capital can create major benefits. So you don't have to start an evaluation right away. You can just build in that recognition of the value of nature throughout your supply chain within your company, and then pick one or two things that you can, a measurable accomplishment that you can say that you've completed, and just get the ball rolling.
Mm-hmm. That's great. Do we have any other questions in the room?
I think there's a question about how, what causes this to be a success in some companies. So here I think it's really about leadership. Like if you can convince your leadership that this is something important by starting with measuring some of those impacts already, then you're well positioned to escalate
make the
priority. Yeah, and of course not every company has leadership like Puma, who's so engaged in this topic. But if you can just start with quantifying some of those key risks and savings opportunities, then you can slowly raise that in the company.
That's such a great, it's a great point, because I think it's what got me excited about natural capital in the first place, is that, we keep coming back to the conversation of building the business case for sustainability, and this, to me, provides the rigor and the framework and the real, I just see enormous potential in adding this to the balance sheet. I see this emerging, and I see, the Sustainable Accounting Standards Board in the UK emerging, and folks are looking at a way they're evaluating balance sheets very differently now. That's why I'm excited by this, because I feel if you're going to bring the chief financial officers into the conversation and have a real impact on business at scale, that this is the way it's going to happen. So that's what kind of gets me jazzed, if you will, about the idea of natural capital and business taking this seriously. Yeah. Mm-hmm. Any other questions online that are emerging? No?
We should run the survey.
Yeah, so is that a good time to run the survey? Yeah, great. Okay, so one of the nice things about the Cisco WebEx system is it allows us to run a survey mid-presentation, which is great. So Stephanie's just teeing that up on the survey now, so we've got a few questions for you about it. If you have any other questions for Agnieszka or Caitlin, please feel free to type them into the selection below. And again, all of these resources will be distributed after the seminar. So, do you want me to go through the questions and just kind of prompt people for responses?
Oh, so those questions are included in the survey that we're going to distribute afterwards?
Oh, okay, perfect.
Yeah, something else.
Oh, this is entirely, okay, this is separate. I'm going to be quiet now, and then I'll let Agnieszka jump back in.
Yep, you can see the results coming in live.
Oh, that's great. So just trying to get some feedback on people's level of interest in the topic of natural capital and what motivated you to join the call today, given that it is an emerging topic and many folks are kind of just dipping their toe into the shallow end at this point. So why did you decide to attend this presentation today? Just going to give a few more seconds to get additional response from those of you on the line, and we'll have some real-time feedback in a moment.
So most people joined for general knowledge, really, and but there's a significant amount here that I wanted to hear about methods and tools.
Methods and tools. That's
but,
right.
Yeah, all the options there are selected. Yeah, that was helpful with planning new initiatives. There are a few people that want to understand the business case.
Yeah, that's great. So the majority of the people looking for some general 101 knowledge on natural capital, but also people looking to understand the business case, looking for methodologies and toolkits, and some folks that are in the early stages of planning a new initiative. Great. And there's additional?
I think with any other questions, we can follow up through our email.
That's great, yeah, because we are at 2 o'clock. We're at the witching hour now, so if you do have any additional questions, you can
email Agnieszka as well. I think her contact was on.
She's included there as well.
Yeah, and we'll hand out Caitlin's.
Oh, that's right. So yeah, Agnieszka's email address is included at the bottom of that page there. For those of you that have additional questions, you can spam Agnieszka. That's great. Well, thank you both for coming today and for enlightening us. I hope that there's a brief survey that'll come out after. I hope that we met your objectives for the webinar today, and that this is a good use of an hour. Thank you so much, and please keep your eye on cbsr.ca for additional programming. We have a series coming up, one event on animal welfare in the food supply chain. We're looking at we're working with the Canadian Institute of Diversity and Inclusion on a webinar related to diversity and inclusion and its connections with CSR. And we're doing a whole professional series this year where we're connecting CSR professionals and their colleagues like HR managers, risk managers, procurement managers to make those correlations between the associations between their role, their programming responsibilities, and perhaps the influence they can have throughout the broader organization. So any feedback or suggestions or comments, please feel free to email us directly, and have yourselves a wonderful afternoon.
Thank you so much, and we look forward to continuing the discussions with you.
Great.
Yeah, thank you.
Bye for now.